Good afternoon, everybody. Oh, there goes our closing bell. We are ready to have selecting an option strategy. Last week we had a survey, and you guys were fantastic about filling out that survey, and you pumped a ton of questions to me that you would like to have answers to. So today, I'm going to try to take a shot, see how many of those we can knock out, as we also examine new trades and monitor current trades we have going on. So that pretty much will be our agenda here today as we answer those questions. Now, I should be joined in the chat by Mike Fairborn. If you just came from Mike's class, he'll be coming over here as well. But if you have questions, go ahead and chat those in. I'll keep my eye on the chat. Mike will take a look at the chat and try to maybe pick up some things that I can't quite get to. Now, I hope you're following us on X. I'm Connie Hill CS. He is Mike Fairborn CS. We'll post educational content out in our X account, things we notice with charts or news or things of that nature. We'll be sure to share them with you. Let's go through our disclosures and then we'll lay out our agenda here today. Options carry a high level of risk and are not suitable for all investors. What we talk about today is for general, educational, and informational purposes. Don't consider it a recommendation. We will be using the Paper Money software application. It's for educational purposes only. I think it's a fantastic tool as you're experimenting with strategies, trying to get some rules down for them, as well as just knowing how to do trading in the Thinkorswim platform. Investing involves risk, including the loss of principal. Past performance of any security or strategy does not guarantee future results or success. When we do stop orders, there's no guarantee that execution of a stop order will be at or near the stop price. Typically, it's going to trigger as a market order, and those market order prices aren't necessarily guaranteed. All right, we have some upcoming events. If you can get yourself there, you will be a happy camper that we sent you there, okay? 2 events coming up in New York, a market drive event, which is a one-day, and that's going to be on a Saturday, and then a couple weeks later or a week later, we're going to be doing August 8th and 9th, a workshop that'll be advanced, well, that'll just be technical analysis, I should say, and options. And then again in Chicago a couple weeks after that, or actually just kind of a week after that. So if you can get to any one of these, they are filling up fast. If you have any inkling that you might want to go ahead and sign up before we have to lock the doors, because they do fill up. There's only so many people we can stick in that room and still have everybody be happy. All right. Now our agenda is fairly typical each week. We'll look at what market conditions are, look and see what maybe our bias ought to be, if we ought to be bullish or bearish. And then we'll come back and look at different option strategies and which ones we might consider right now. We're going to look at a lot of examples here today because we have some continuation of some trades from last week, as well as putting out some new trades for today. So it is great to see all of you here today. Let's go take a look at the markets. Now, just closed here a minute ago. I've got the SPX up, and looks like what? We ended up down 0.84% here, so not quite a percent, not a really big move in the market, but maybe we're starting to see a little kind of stalling out. Right? Sometimes the market will do that when there's nothing news-wise to really push it one direction or another. So sometimes we'll get in these sideways patterns here. And when we do, we may see a lot of stocks having sideways patterns as well. And so we might think, oh, okay, maybe not super directional. Maybe we choose strategies that are less directional in nature. Let's look at the NASDAQ. Go to NDX here. And both the NASDAQ and the S&P are getting close to hitting back to these highs they had in February. They're not quite there yet, but they're moving that direction. And NASDAQ's been moving a little bit sideways here as well. Okay, so very similar patterns. It is, however, staying above its 10-period moving average. That's the blue line. The 30 is a 30-period simple moving average. And so it is kind of intermediate term, but kind of on the quick end of that intermediate term. So we can see the trend definitely is still bullish, but maybe just for a temporary short period of time is going a little bit sideways there. Now the VIX. The VIX done a lot recently. Well, it popped a little bit today. Obviously not clear to these high levels, still maybe in a range that we might consider more conservative, not to expect extreme action. But it did get a little bit of a pop here today as the markets did pull back. So a little bit of volatility in the market, a little bit of uncertainty, a little bit of concern about what might be going on in the market. Okay, but nothing, not jumping above 24 or in this intermediate range here, not really staying there. But if it were to, then we might be a little bit more concerned about maybe having some bearish bias, because we'd probably start to see the market sell off at that point. All right, now let's get to a couple. Well, okay, based on this, okay, would you be more bullish, bearish, or neutral? Answer that to yourself, to your computer, to the dog, if you've got your dog or your cat there. What is your bias? Are you thinking a little bit more bullish? Are you thinking maybe I should peg neutral strategies or more bearish? I'm going to say probably bearish is off the table, probably for most of you. Let's go look at our strategies, and then we're going to come back over and look at some examples here. So unless some of you are quite bearish, there could be some opportunities for a short call vertical. Okay, maybe in stocks that are weak, would take advantage of stocks maybe downward trending that maybe are having a little bit of a bounce down. That's a possibility. Put diagonal could be a possibility there. Generally, if you're going to do a diagonal, you're looking for a little bit more directional movement than just say what you can do with a short call vertical. Okay. Neutral strategies. Sometimes we will entertain this idea of doing an iron condor. Many times what we're looking at in this class is putting together a short call vertical and a short put vertical that create this iron condor. Somebody had a question about iron condors in your comments, and I don't know who says what. Okay, I just see what comes in. And somebody said, can we spend a little bit more time on iron condors and butterflies? In an appropriate market, we will spend some time on iron condors, but when we're in trending markets, generally it's not going to be a strategy that we're going to utilize a whole lot. Now, an iron butterfly and some of those advanced strategies really get covered in the advanced option strategies class. I believe that's on Thursday with Brent Morse. And so I have to kind of stay in my lane, all right? And so if the strategy is not listed here, then for the most part, we're probably not going to review it too much, okay? But if you are the person that's looking for some information on iron condors, Brent's class is absolutely the best place for you to go. Now, just kind of checking what your responses are here. We've got a neutral, a bearish, and bearish is going down, isn't it? Yes, bearish is going down, okay? Bear swipes. When they're attacking, they swipe with their paws, and they kind of go in a downward action. That's where the bear part comes from. But a bull, when a bull is attacking, they get their head down, and they flare up their head and those horns. And so they're attacking in a different manner. And that's kind of where we get the bullish and bearish from. Okay, knowing how they attack might help you remember which one belongs the bullish way and which one's the bearish or downward trending. Okay, because we're maybe a little bit more neutral with a bullish bias, right? Because we're still getting higher highs and higher lows. We might not feel super strong about long calls, but there might be some that drop in your lap. We could consider doing a cash secured put, collect some premium, and if we put the stock, we don't mind. We might entertain long vertical, short put vertical. Either of those we might consider. Last week, we kind of started the beginning part of some diagonals that we're going to leg into. We're going to talk about that today. And somebody is really bullish, either with a bullish market or bullish stock. If they want to do a synthetic stock, selling a call or selling a put, buying a call is a very bullish position, trying to kind of emulate a delta of 1, then I would say that's a very bullish strategy. Okay, Rebecca's saying I am bullish. Okay, so kind of neutral to bullish, I think most of you, with the exception of Vivek, that's looking maybe for some bearish opportunities. We won't actually be looking for bearish opportunities today, But you know, there could be some that are appropriate just because the market's getting a little bit sideways. So I could see somebody, you know, maybe looking at short call verticals for that reason. Okay. I put a thing next to the wrong one. Short call vertical, not necessarily the short calls, although it could be short calls if you want to sell some premium. Now, last week we were talking about a strategy we haven't spent a lot of time on. And we were looking at a bullish market. And so we said, you know, we're going to buy some longer dated options and we're going to try to sell shorter dated options against it, but we're going to leg into it. Legging in means we're not going to do it at the initial time of the trade. We're going to wait for some timing. Okay. So we are going to look at a couple of those here today. So, let's talk through this, and then I'm going to go back to my list of some of your questions here. Okay. Let's go back to our Thinkorswim. Last week, we bought some long calls. We just actually did one. We did one on AMD, and let's maybe just see what its status is right now. I'm going to need to collapse some of these areas so we're not distracted too much. Get our option strategies only open. So one of the options we got into was we bought a longer dated option here. The November 25 is what we bought. Now, as I was watching this stock through the week, there could have been some times that we could have sold a call against it. And the idea of selling the call against it is that we bring in some premium. We're trying to time so we maybe kind of get at a peak or when it hasn't pulled back too far. Certainly not looking for it to bounce there. Okay, make that be up a little bit higher in its pattern. And then we would want to sell a call. Now, the opportunity really looked, I'm going to say, worthy, okay, of something like that in today's market with AMD. All right, so last week was the 10th, and so we got in here, the 10th right here. Yeah, because that was Tuesday. Actually, we probably got in on the 11th because we looked at it Tuesday, put things in, but the market had already closed. So we probably got on this day, looking for that nice continuation after breaking out. And what did the stock do? It pulled back. Now, we ended up getting in here on the 11th on Wednesday, and it started to pull back immediately. Now, had somebody been on their toes, they could have, if they wanted to, maybe sold a call against it at that point, which could have been, you know, even later in the day or the next day. Okay. But down here on Friday, it was like, ooh, it's trying to make its way back up. Maybe that's not a good time to sell it. And then, of course, yesterday had a really bullish day. And so we're up on the position a little bit. But then what candle are we looking at here today? Hopefully you guys are getting accustomed to maybe what some of these candles represent, because it might give us an indication of what is likely to happen, although nothing's ever guaranteed, is it? Right? But what is maybe could happen tomorrow. So we have a bullish candle here. We have this candle that at one point in the day, it was up here. And then what did it do? It fizzled out. Okay, so the name of this candle, we might call it possibly a shooting star because it did gap up, ran, and pulled back. It could also be the second candle of a 3-candle pattern, and that pattern is what we call an evening star. So an evening star comes at the top of a trend. Evening star is going to be like the stars at night. When do we see the stars at night? Well, we're going to look up to see those stars. Okay. If it's down at support, we call that a morning star because that's kind of symbolic of the sun rising in the morning. Okay. But the one that's at night, we call it an evening star. Now, tomorrow, if we have a candle, oops, I'm going to let that fade away. If we have a candle that maybe starts down a little bit, okay, maybe it even gaps down a little bit and it goes well through the body of this first bullish candle here, then we're looking at what looks like is setting up to be that evening star. But we are already seeing the shooting start, and for some, they could take that as a bearish, or not so much that the trend is bearish, but just maybe there's going to be a little pullback, and that can be a good time to sell a call. So I didn't wait till we had our class, but I sold it earlier today, okay, because that's what we were seeing on the chart. Now, if we come back to the monitor tab, we'll show you here our long option that we're up on a little bit right now, about 245. And then because we sold this option, let's see what time of the day it was when I sold it. It was about 12:18 Mountain Time. Okay, so I'm in the Mountain Time Zone. So about 18 afternoon, or about 2 hours ago is when I sold that. Okay, and then since then, it's pulled back a little bit. Okay, so we're up just a tiny bit on that call. Well, what we're hoping to do with the premium, because we brought in 270, is to help pay down the cost basis of our long leg. Now, this is not showing exactly what oh, okay, there it goes. I lost the November one. I'm like, where did it go? It's playing hide and seek with me. Okay, there it is. Okay, so it was an expensive option, $17.80. But with this money that we bring in by selling that call, some traders will look at it as maybe trying to lower their net debit, right? So maybe $17.80 minus 270, right, makes that output of cash a little bit lower. And what the intent would be to do that a lot. We could be very active with the strategy doing that. Okay, so that's what we did today, is we sold that call against it. John wants to know, I would like to know how it performed over the last 6 months. Are you talking about the stock itself? I'm going to guess that's what you're asking about here, John. Let's come back. Let's give you a little bit more of a look. This is a 6-month chart. And so, yeah, a lot of the semiconductors, what was happening? Yeah, they're getting a little beat up over the winter, and then bottomed out here in March, and then have had kind of a spring going into summer with a little bit more bullish activity. So it's not that we're bearish on AMD at all, as it is so much, maybe it's just running out of steam for a little bit. We can collect a little bit of premium. We're going to be active with it. We're not just going to like sit around and wait for it to expire necessarily. We're going to let it pull back here and hopefully decay. And then when it gets to a point where we think maybe it's getting ready to bounce, we might just go buy it back. We're not going to wait for a specific number to buy it back, but we're going to be reading the chart. We're going to be using our technical analysis skills. Okay, so let's suppose maybe it pulls back here, and then maybe it pulls back to the 10, maybe even a little lower than that. And of course, these are over different days, okay? And then maybe it comes down, it hits the moving average, or maybe like a couple of days in a row, it just kind of stays at the same level. That might be giving us the idea that it's found some support, and it might be getting ready to bounce up. And so that's when we would pounce on it and say, let's go buy it back. Be happy for whatever we made during that little pullback. And opportunity to sell some premium and further reduce the debit that we had on that expensive AMD contract. Okay. So John says, what I guessed was correct there. I think this pullback is merely temporary. Yes, it's merely, we think it's probably just temporary. We don't know for sure, but that's why we took that action today. Now we had one other one we could do the same thing on. We had Qualcomm. And let me get off my marker here. And Qualcomm, we got in last week as well. Placed the order after the market closed on the 10th. So the 11th, let's see, the 10th, things were looking like this. It was looking like it broke through that resistance there. We would have got in fairly early when the market opened, and then it ran up. But then what did it do? It started to close a little bit here. And it's pulled back since we got into it. Now, if we had been Johnny and Jane on the spot, we may have considered selling the call back here when it started to pull back, or even on this day. And today, as I was looking at it, it was up earlier today. So I thought, okay, maybe it's given us a little bit of a bounce here. Maybe that's what's going on. And therefore, it wouldn't be a good time to sell a call against it. But when it changed and pulled back and went, its body went even lower than where it was here. And I said, okay, let's go ahead. It's weak enough now. Let's go ahead and sell a call on it. We'll see what happens. We'll be very active with it. If it just bounces up tomorrow or the next day, then we're not likely to do anything about it. Okay. But this is what we were looking at. So let's go look at the numbers here. So on Qualcomm, here's our longer dated contract in October. It cost us $16.50. Okay, so a little bit of expensive because the stock's gone down. The price of the value of that option has gone down as well. And here we sold it when it was $287 is what we collected in premium. Again, if you're filling out a trading journal and you were trying to keep track of these sells, of these calls that go against you, using a trading journal might be really helpful for you because it's not, I mean, the actual transactions will be conducted and they'll show in your account, your paper money account, and your live money for that matter. But it doesn't take into consideration all the times you sell a call and then go buy it back. That doesn't filter into the P&L loss numbers. So that's why you kind of have to track it on your own. Okay, so we're up a little bit on it. We're up a whole $11.50. We'll take it. And we're going to do the same thing. We're going to see if it continues to pull back. And when it starts to show strength, we might decide to buy it back because our purpose is to want to sell different calls along the way to try to lower, this was a $16.50 option. Okay, we want to lower that in essence. All right, those were those two trades. Now, we also had another trade that I want to talk to you about. And it was on, let's go to the trade tab here. It was on EXAS. And at the time we were looking at this trade, what we were seeing was that the spread was a little bit artificially wide. And when I had seen it earlier in the day, it wasn't nearly that wide. So I said, well, let's put it in. And tomorrow morning, I've got to watch, make sure these trades go in. If it doesn't, the spread doesn't come back down, then I would make a judgment call on it. So the next day in the morning, I was watching and looking at the bid-ask spread. It's even wider now than it was then. And because it didn't shrink back down, okay, then I went ahead and I just canceled the order, okay? And in its place, I put in something else. It was a trade I had wanted to get to, but didn't quite get to. And that was with AT&T, okay? So the next day, so we'll bring up AT&T, same thing there. So we were now looking at this on the morning of June 11th. Okay, so the morning of June 11th, it had looked like it was breaking through resistance. It had this really nice, oops, that was the wrong direction. I want to zoom out. It was kind of in an ascending triangle here, which is a continuation pattern. It's a bullish continuation. And it looked like the day that we looked at it, that it was breaking through. And really, a technician would say, hey, let's measure the height of this triangle, and that might be our target. Well, what did it do the next day? Well, in the morning, sure enough, it started running up, and so we went ahead and got into that trade. However, what's it done since then? Pulled back, pulled back, pulled back. Now, this particular one, I did not keep as much of track of, okay? Today, I analyzed it. Is it worth selling a call against it now? Because we didn't do it in this little pullback when it could have very well been appropriate, right? Here it's kind of above support, so you're like, I don't know if it's really going to be able to pull back. Maybe it'll just use this as support and bounce up. But maybe by yesterday, after yesterday, you're like, okay, it's back into the triangle, so maybe this was a false breakout. And at that point, yes, somebody might have determined to sell it. Now, today I didn't sell this one because it was so close to support. In fact, I tinkered around with this line a little bit here. And I'm going to kind of put it so it's touching the bottom of these candles. And it was looking like, man, it's almost down to support. It could bounce. So if it's looking like it might bounce, that might not be the best opportunity to do that. Okay, so we're going to watch it as well. Now, did you happen to, if you had any questions about any of these trades that we looked at last week, sold calls against this week, canceled and put in again on T, go ahead and let me know. Yeah, John says, maybe give it another day and see what direction. John, I don't know if you said that about T or about Qualcomm, but in any case, that's what it was. Yeah, Greg says, no, the IV is high. Let's go look at the trade tab here. And let's look at the side here. Now, Greg, if you're talking about implied volatility on these options, I wouldn't say they're super high. Okay, they're in a range that is maybe, once we maybe get over 35%, then it starts getting a little higher. So I would just kind of call this maybe in a medium range, maybe something that's lower than, say, 20. We might call that in a lower range, okay? Now, this is low compared to some other high flyers, absolutely, right? Where we've got 70 and 80 and 90% or plus implied volatility priced into the options. Yeah, those are very high. And so compared to those, yeah, I would say this one is a little bit lower as opposed to a little bit higher on this one. Now, if I'm catching that comment too late, Greg, you can correct me on that, okay? Next question we're going to tackle here. And that is, let me get to it. Now, somebody asked, could we cover some specific guidelines on exiting long and short verticals when the trades are against you? Yeah. Right now, the trades have been falling out pretty well for us, but we have had some opportunities in the past to talk about that, okay? So we're going to go out to the Trader Talks channel. I'm going to point out a couple of webcasts to you. So let me bring that up here. And let's get to the right spot. That's not the right spot. Let's come over here. And we're going to come over here to, I'm going to click on Trader Talks to our channel. Now, when you have subscribed to Trader Talks, and if you haven't yet, go ahead and just click on that button down in the bottom right. It'll allow you to find our content a lot easier. Maybe I'm going to take this down maybe just a little bit so it's not quite so big in our face, all right? And what we're going to do is we're going to come over here to the playlist, and we're going to go find the playlist for this class because I'm going to point out to you when we have gone through those exact scenarios, okay? So we're going to be down here about 7 rows down. And let's see here. Selecting an option strategy right here. So I'm going to click on the play all, and it's going to bring up a list here. Now I'm going to mute this. This is our last class. But we're going to come back here and let me find the right one. It's been a couple of months because some of our trades have gone fairly well, so we haven't needed to do that. Let's see. It might have been this one. I'm trying to read what that says there. Maybe I do need it a little bit bigger. I made it a little smaller, and guess what? My blind eyes, my vision, my failing vision might need it to be a little bit bigger here. Scrut, I'm not seeing it right off the bat. Managing risk by adjusting your strategy. Okay, that particular one, I believe we had a couple of short verticals in it that went against us. And so we talked about what we call a change of polarity. And if you see a change of polarity in one of these titles as well, that one's going to be about buying back the short leg and going with the long leg. And we had a couple of examples. We had a couple of trades. They were short put verticals, which we expected the stock to go up, and it just broke down. Okay, and in that case, we went back, we bought back the short vertical, or the short put rather. we held on to the long put with the expectation that the stock had time enough in the trend to continue to drop and that it would drop. We bought that put back at a really high price, at a pretty decent loss, and we wanted that long leg to really move down and help make up the deficit for buying back the short leg at such a high price. Okay, so we had a couple of examples of doing that in those webcasts. Okay, so if you're like in that situation, hopefully we'll have some examples coming up that we can do that with again so that we can go through that situation. But we won't go through the situation unless we have a trade go awry, right? Because we're typically going to be trading the trend. We're going to be looking for entry signals. We're going to try to follow the rules just as best as we can. And that doesn't mean all trades work out for us, because sometimes they don't, right? Sometimes it does something you didn't expect or market conditions changed, okay? But that is the answer to somebody else's question. Another question, let's see here. Goes back to our discussion on wide spreads. Let's come back here to Thinkorswim. Let's go back to this stock, EXAS, because the question has to do with wide spreads in after hours. So we're after hours now. Let's open up the July options. Those are some monthly options, but we can see, yeah, there's not horrible open interest here, although the more the better, right? But 390 by 630, you're like, well, what's that up? What's up with that, right? That's more than a $2 spread there. What, about $2.40? Like, that's ridiculous, right? And so when you do see those wide spreads, it could be because of certain things. One, the volatility could be higher. And it's interesting because as we look at implied volatility here, looks like about 49% higher, or 49% implied volatility priced into those options. Could be that they have an earnings announcement that week. It could be that they have maybe some big news that's going to impact them, and that's why implied volatility is higher. Because we can see these weeks out here aren't really that high, right? 22%, 27%, 37%. They're not nearly as high as this 49%. So that could be one of the reasons why it's higher. Now, sometimes in after hours of action, we're going to see the bid-ask spread go wider. Okay. The question is, why does it do that? And really, when you see those orders in after hours, when orders come in, they might be put in for somebody wants to sell for something, somebody wants to buy for something. And so depending on which exchange is getting that information, it will just kind of update the bid price and the ask price. But it's not a real reflection of what's going on in the market. Although today, when I came out and checked this one, yeah, they were still artificially wide. So this might be the kind of stock that we say, even though it has decent trading volume here, even though maybe it has some decent open interest for somebody doing smaller number of contracts, we might say, we're just going to take it off our list. We don't want to even bother with it anymore if it doesn't have tradable options. And maybe in the future that'll change and we would put it back on a list of stocks that we are going to consider using for any kind of trade. All right. The other part to that question is there a way to look back at the spread during normal market hours? The answer is yes and no. Yes, with ThinkBack. Okay. We come over here to the Analyze tab. We come over here to ThinkBack, which is this icon here. We can look at any stock and we can look at their option prices as of a certain date. So this is just has Monday's date in here, but let's go say last week. Say on the 10th when we were looking at these prices, okay? What would we see reflected? So we change the date and say we want to see the prices as of the close of June 10th. Okay, you pick the day that you want to see them. Now, does it track every single price in there? No, but it does track closing prices. This can be helpful if you're back testing strategies and you're going, Maybe had I bought a protective put, how much would it have cost me at the end of the day? Then maybe a stock has an announcement. And what did it open at the next day? You can go back and get that kind of information out of Think back here. Okay, so that's what it is all about. And as we can see here, say on June 10th, the spread, say on these June options, which we probably would have been looking at July and not June. Let me see if I can scrunch that a little bit. I guess not. It doesn't want to scrunch for me, but we can come down here. We can see what the closing price was. 610 by 640, 440 by 470, $3 by 410. That one's kind of on the significantly large size. These two not so bad, 30 cents here, 30 cents here with less than 10%. But yes, that's how you can go back and look at those numbers. All right, next we need to put on some new trades for us to track. Now, first one we're going to take a look at here is ticker symbol FRO, Frontline. Now, if you've been tracking oil and you've been kind of seeing what's going on with crude oil contracts, and if you want to see that futures contract, we don't trade them in this class, but certainly can be helpful to track crude by pulling up the futures contract is /CL. And you look at that pattern, you're like, man, it had a big move Friday, dropped immensely yesterday. This is like a piercing line kind of candle, which means typically the next day would see another bearish candle, but it didn't. Instead, what do we have today? We have a really strong candle that's bullish, and it's trying to make its way into a piercing line. And a piercing line, the deeper it goes into the body of the previous day, the stronger that move is. Now, as I put my mouse here, I'm going to say maybe it's about a third of the way through the candle. If it were halfway or more, then it would probably say, okay, that's a stronger look. Nonetheless, that's what we're looking at. And on Frontline here, it's kind of looking similar in that we get the big bullish candle Friday, the pullback yesterday, and then today, instead of actually kind of pushing into this area, it gapped up from the close here, and it stayed really bullish all day. Okay, so it had some decent volume here. It also had some decent volume here the first day it broke out. So we're looking at kind of a breakout there. All right, let's go over and look at the options. Now, in your mind, I want you to ask yourself, what strategy would you consider? Okay, you personally, John could be different than Tom, okay, or Greg, right? You might have different answers to this. Think to yourself, what strategy would you go to? Now, I do have to say we have a survey out in the chat. When I made my screen a little bit smaller, it shrunk all those comments down. But there is a survey out there, and you guys, well, I guess we get 2 weeks in a row. Usually they mix them up, all right? But this is your opportunity to have a voice, all right? And with the survey, we just ask that you fill it out. It has 2 questions if you just want to go plop, plop into the radio button on a scale of 1 to 10, okay? 1, as Barb says, I hate it. 10 is I loved it, okay? Just on a scale of 1 to 10, you can answer those questions and be done. There's also 2 questions that if you want to, you can give me some answers to. And the answers on that scenario are, you could answer the question, or you can use it as free space to send me a message about some of the questions you have, some of the concerns you have. And actually, that's what I was saying. You guys did really good last week. We were able to knock out a few questions, not as many. There's a couple more that I would have liked to have touched on. So if you'll just click on that link right now, just let it sit in the background. Then when our class is over, go ahead and fill it out. We really appreciate the time that you take to do that. And I like that it's not annoyingly long, okay, on that front. Okay, strategies. Greg says, more money, but more likely to bounce too. Actually, this is John. Greg says you're looking at the high implied volatility study. Okay, so it wasn't actually the percentages on the chart. Okay. Greg's saying personally he might look at a short put vertical. Okay. Doesn't mean that that's the only trade that could be considered, but if let's go to the volatility. Okay, we have the chart look. All right, if we go to the option chain, and I'm going to kind of collapse this out of the way, we can see implied volatility is a little high here, 82%, 51%. So some people might move towards a selling strategy there. That very well could be the case. Something else that determines which way you might go might have your expectation for the stock movement. If you're expecting big movement or smaller movement. If this stock were starting to maybe get in a sideways pattern, and some could argue maybe it's there, yeah, you might opt for more of, say, a short put vertical. But there could be others that say, you know, I think that candle's big enough. I think we could go directionally with it and do a long call vertical. Okay. Or another strategy you could choose. Just because we're going to do a particular strategy, although it's not looking as good here as it was earlier. I think that could be with the after hours pricing. I was looking to do the 1920 long call vertical here. Okay. Now this spread right now, as it stands after hours, is a little bit wide. It wasn't wide like that when the market was going on, and you can see some of these other strike prices. That one's a little bit wide there, but $1 by $1.15, that's a little wide. If we were to look on the short put vertical side, I think we're going to have problems not having a lot of choices. Really, the only one we probably would consider doing here is a short put vertical. But I really would love to see a lot more open interest here. We got a little bit of volume today. So for this reason, we're going to stick on the long call vertical. I'll look in the morning, see if these spreads do shrink up again, like I'm expecting them to. All right. We're willing to risk $35, hoping for the stock to do what? Close beyond the 21 strike price. Okay, so we're buying the 20. Stock that's kind of at the money right now, but it is going to require a little bit of movement. Now, if you don't think that stock is really going to move that well, you might not consider this strategy. Okay, we're looking for a move. We've got 31 days for the stock to move to get beyond 21. And really, you know, yesterday it was down here as low as 1842, went to 19, went to almost to 20 now. Okay, so it's kind of been wiggling around a little bit. So we're going to do 10 contracts here. We could actually do more than that, but we'll just do 10 contracts. And I will look to make sure we do have a better spread than what it's looking at like right at this moment. Okay. Let's do not a blast all. Let's do a first trigger sequential. We're going to put on an opposite order and say if we get a chunk of our max gain, let's get out. Okay, well, what's our max theoretical gain here? Well, if our loss could be 35 cents, then 1 minus 35 cents is going to be what? That's going to be what? 65 cents, I believe. Let me make sure though. Okay, 1 minus 35 should be our 65 cents. Okay, when we get a chunk of the 65 cents, let's be out. Okay, so we're going to go 0.65 times, let's go 70%, okay, times 0.7. That's going to put us at, buy it back at about 45 cents, okay? Our time's running short here, so I will not place the entire trade because I want to show you one other stock that I'm going to place a trade on when our class is done. And it might be something that you might consider. Okay, if you're looking for some example trades that you could do here, we're going to take a look here real quickly at Celsius, and it's having some nice movement, some nice bullish action, right? The 10-period moving average is headed up. Looks like today it kind of bounced down kind of in that area and decided to run back up. So it's looking like some people might use it for a bullish entry signal. Yesterday could have been like a hold, close above the high of the low day, and today with just a little bit more follow through on that. Okay, is what we're seeing. Now here we could either do a long or a short vertical. I actually was going to put on both. So I'm just going to show you real quick the options. And we're going to put on a short put vertical as well as a long call vertical. Look at this open interest, you guys. Ooh, this is lovely. We love to see thousands of contracts in there, hundreds of contracts out there. It makes it a lot easier for us to get filled and to get into trades and out of trades. Okay, so I'll show you what I put together next week. We're going to do this on Frontline, and then I'm going to pick out our short call and our long call vertical, and we're going to compare them to each other. See what we learn from each of those strategies. All right, we had a lot of ground to cover here today. We had lots of questions. We had some follow-up on our trades because it was time and we needed to sell calls against the long options we bought last week. All right, I hope you're doing some of these practice trades along with me, especially if you're unfamiliar with those strategies. If some of these strategies were new to you today, you might consider going back to the Getting Started with Options webcast. Go to the playlist out on our channel, and you can say, you know, if you're like, man, I'm not really familiar with long call verticals, go to that class on Getting Started with Options so you can learn those strategies, starting getting more comfortable with them so that as we talk about what are we seeing in the market, what strategy might be appropriate, you'll be able to follow along there. Now, this is the last webcast of the day. Thank you, Mike, for helping out in the chat. Mike has posted that survey again. If you'll do me the favor of answering the question, appreciate it. All right, we'll check back with you next week and follow up on these trades.